Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next half hour here on Options Guide TV. And I'm just going to start by tossing this out there. If you are watching on YouTube and you do have a little chat box open up, if you have any questions during the show, we want to make this very interactive. And so one of the benefits of doing this via the different streaming platforms is that we can interact with anybody that's out there that would like to ask any questions. So Options Guide TV is all about looking for strategies that will match the market conditions. So the main rule behind Options Guide TV is that there isn't a golden rule of this is the strategy that you have to do and do it time and time again. So if I look at the strategies that we have done this week, I'm going to actually start thinking about an advanced strategy that I really don't see a lot of opportunities. We're going to talk about a long straddle today. And it's not a very popular strategy with a lot of option pundits, if you will, to buy premium as opposed to sell premium. But I do try to find conditions where I can apply almost any of the 40 strategies inside the options playbook. I want to be able to say, this is a time in the marketplace where I think the pricing is right to do this strategy. And that's where I'm at with the long straddle. I'm thinking about putting on a long straddle in a fairly big position once the timing gets right. So I want to do that setup today. But before I get there, this week on Options Guide TV, we looked at a couple of condors, iron condors. We looked at, well, I should say last week, we looked at a longer term iron condor, one that would be a staple of a portfolio that you might do month in and month out, going out over, I think it was around 40 days when we put it on. That's the days to expiration that was in the iron condor. And that trade is looking really good. And I said, well, since that trade is panning out, let's try to do one a little bit more speculative. And I'm going to focus on that strategy because we put that together on Monday and just talk a little bit about what has happened in the markets since Monday. So with the Fed, we have a big meeting in November, and it was actually a scarier meeting at the beginning of the week or even a week prior, where there was a probability or a chance, at least the futures market was showing, that the Fed might raise interest rates by a quarter of a point. That probability, based off of the futures and the CME Fed Watch tool, is now all the way down to about 8%. So the hawkishness tone of the Fed and the people that are out making public statements has really subsided. The 10-year has helped in a weird way. Not really good for the markets, but the 10-year ran all the way up and almost got to the 5% level, but the highest that the yield on it, the highest that it's been in quite some time. But right now, looking at the Chicago Board Option Exchange TNX index, which tracks the 10-year, we're at 4.63. So it's came down a little bit. It's given a little bit of a bump to the marketplace. But this morning, I saw something interesting in that the SPX was up, I think it was about 6 or 7 points. And we saw the VIX index actually climbing. And the VIX index was up maybe 1.5 points. So we had the SPX up and we had the VIX up. And that just doesn't happen that often. Every once in a while, you get a little blurb like that, but it kind of stayed that way all morning. And now we've seen the reversal in the SPX. And a lot of times when you see the VIX up and you see the SPX up at the same time, it's a hint that the marketplace isn't really believing in the move. Now, it's just one data point. It doesn't mean you should instantly get short the SPX. Today, it would have worked out well, but you want to look at a whole bunch of other things as far as the SPX is concerned. But that is one little indicator that might say to you, if you're a day trader, maybe I want to get short some VIX options when at least even in a swing trading scenario. And the biggest news, well, I don't know about the biggest news. Obviously, the geopolitical concerns and all the conflicts that we have going on around the world are big news, and it's really affected the price of oil. We've seen a lot of volatility in the oil prices. We've seen oil come crashing down, and now today it's up strong. And right now, the barrel of oil is trading at $86. About 3 weeks ago or so, it was trading above $90. So at $86, that's where oil is at. It's up a percent or so today. Very, very solid movement to the upside. But it was good for inflationary concerns to actually have oil coming down a little bit. All right. So my stance has been for almost the entire month of September and going into October that the markets are really neutral, and I didn't really want to get bullish on anything. We came out on Google on Wednesday and said, well, maybe let's dip our toe in the water and start building a portfolio based off of deep in the money options. And I'm going to track that portfolio. I'm going to try to build a few positions, and I'm going to go into the TradeHawk software, and I'm actually going to use the paper trading app, and we're going to build that portfolio probably on Wednesdays. It's always a good day in the middle of the week for Options Guide TV to try to, if you're going to get long the markets. I still think that there's going to be we still have this big kick the can down the road thing that the government has done. And I think I might have said on Wednesday that it was November 11th. The drop down date is November 17th. And I do think that all that's going on with Congress, we do not have a Speaker of the House, and it doesn't look like we're going to have anyone anytime soon. The House can't really do anything. We have a huge situation in Israel. House cannot appropriate any funds unless there's a Speaker of the House in, and hence we're seeing the VIX finally react to that. The VIX right now is trading at 19, and it was at 17 on the open. Now it's all the way up to 19, 1898 to be exact. And I do think that people are finally starting to get concerned about what's going on in Congress. And we still have a few more days until we hit that drop dead date. And that's when I'm going to think about getting long a long straddle. And we're going to either use the SPY, we could use the QQQ, but that is the precipice behind why I would want to do that trade. If I see the VIX come off a little bit and I can get in at a decent level as far as volatility is concerned, I'm going to consider doing that, because that date I think is going to be a big day in what happens with the marketplace, and it will be a bigger day to the downside if Congress can't get together and come up with a package or a funding bill that is worth something, and not just kick the can down the road. So I do think that will be an issue, and I'm going to set myself up with a long straddle if I can see the VIX come off. So I'm going to be watching that a lot. But right now we have the SPY on. And when Russell Rhodes was on my show about 3 Wednesdays ago, we were talking about the VIX and the fact that the volatility index was trading at a much lower level. Talked a little bit about his favorite trade that he likes to do in the VIX index. So feel free to go back and check that out. Always a pleasure to talk to Russell. But at that point in time, I said one of the biggest things that is kind of holding the VIX in place is that the actual volatility of the marketplace just really isn't moving. And I said the market was at 43.50 at that time, and guess what? We're still there. And if we look at the chart, which I'm going to pull that up right now in the SPX, that's right where we're hanging out. So let's take a quick peek at this. And this 200-day moving average, oftentimes it works as a support. Back here, it didn't hold that strong, but right around the 4,200 level. And this was a very important area as far as the market is concerned. We had the downturning. We don't have the moving averages in line, which you like to have the 200-day below the 50-day below the 20-day. And that's just a sign of a stronger market. But I wouldn't expect it to be that, considering everything that we just talked about. So we're right around this 43.32 level. And if you even look at this as the month of October continues, there's just a lot of noise right in this area. And the marketplace is just trying to figure it out. You see that this was where the market stopped going all the way back. When was that? In August. We hit a little high right there. We're still just really hanging around that range. And that's part of the reason why we've been looking at iron condors. Market is kind of befuddled as to where it wants to go to next. So we want to do something that we're neutral in the marketplace. And then I think once we get over get out of October, which is always a volatile month, and get into November and the holidays start coming in and we can get the budget issue taken care of, I think that'll be a fairly bullish sign going into the end of this year. Still 10-year, the 10-year trading higher. Obviously, geopolitical concerns. There's a lot of landmines that could happen, but I would have a tendency to get bullish if we can get the government issues solved here in the U.S. All right, so let's look at our speculative iron condor, the most recent one that we did in the SPY. And one second. All right, I actually see a few questions, and so I'll do this before I get into that SPY thing. All right, so we have, I'll just go by the initials. ES is saying, been doing well with covered calls around 52 weeks highs on SPY and Big 7, Magnificent 7, I guess that would imply. Looking forward to learning startles, though I may find more straddles, I guess that's what that is. Though I may find more complex strategies hard to use. All right, and yeah, that is true, and that's what the show is about. So come on in, join, welcome in, Eric, and learn about different strategies and different times. Like anybody can read a textbook and say this is a long straddle, and if you read a textbook, the most interesting profit and loss graph is the long straddle. And inside the options playbook, if you look at it, it's saying, well, if you're struggling trying to pick direction, which everybody is, well, why don't you just buy a put and buy a call? And if we do that, one second. Well, if the market is going down, it's going to skyrocket to the downside. You benefit from the put. If the market's going up, you benefit from the call. But it doesn't really take into effect the time decay and how much premium you're paying when you're doing that. So there's very few times when I like to do long straddles, and the one time I really don't like to do them is around earnings. When the marketplace knows that there's a known event that's coming, is when I am the least when it's priced into the price of the option contracts. That is when I least want to do a long straddle. All right. So we will address that. So here's the SPY. Let's talk about the Monday trade. On Monday, we went in. SPY was trading at 32.28. We did the November 3rd expiration. So now is a good time to take a peek at it and see where the market is at. We were able to do this butterfly for $1.05. We were able to sell a put spread for 53 cents and sell a call spread for 52 cents when we looked at that the November 3rd expiration. So let's go in and pull up the November 3rd expiration, and let's look at this one first. All right, so here's November 3rd. We sold the 400 strike put and bought the 395. So I'm going to scroll down and look at, where is my 400? Right here. And we sold this one. So I'm going to click on the bid. I'm going to put the actual trade in, not the closing trade. And then we bought this one. So that's trading for 19 cents right now. When we did it, it was trading for 53 cents. If it came down to 15 cents, I would consider closing this. And right now, I might put in a good till canceled order to close it at 15 cents, just a few pennies below where the market is at. A little bit of a movement in the VIX, and that should actually get filled. I wouldn't mind doing that trade, and I'm going to take off that risk to the downside. Now, if you wanted to, you probably got a decent chance of just closing everything. So now if we go back to the call side, because the market is up a little bit, but not a ton, and we've had a lot of time decay on this trade. So on the call side of things, we sold the 450 call. This is going to be the call credit spread right here. And we're going to click on that bid. And we are in November. Good. Just want to double check. And that's the one that we sold. That's where our risk is on the upside, is if the market goes beyond 450. And then we bought the 455. And right now, that trade is the entire gaggle of securities. If we were to undo this trade, we'd have to pay a debit of 68 cents. We put the trade on for 105. So I like where the SPX is at right now, or the SPY is what I should be saying here. And I would strongly consider just closing out the put side of things, because the marketplace is fairly neutral. If you look at where the 1 standard deviation move is, the 150 strike is right in that range. We see the delta trading at about a 12% chance of it getting there at this point in time, based off of where the market's at and where the volatility is at. So if I could get that short put spread off, I don't mind legging out of this iron condor. And so that would be my trade. So if I'm going to address this iron condor that we put on a while back, I would go back in and I'm going to take off the call side, just going to close these out. And the 400 strike put, I would put in, I'm going to have to put buy to open, because it won't let me put buy to close. Yeah, it just puts in buy to open. And that's only because I don't have that position in. And then I'm going to sell to close this one, which I'm going to have to click sell to open. And right now it's trading for 19 cents. So I would go in and I would put this in for the day, and I would see if I could try to close it around 15 cents on that trade. Now, if you're doing a one lot, which we always talk about one lots here on Options Guide TV, I wouldn't worry as much about the 4 cents. But if this was a bigger position, I had maybe 10 contracts on, did a 10 lot, 10 by 10 by 10 by 10, and that's 4 times. Then I would obviously, I want to get what I want to get. I don't mind closing out any short spread at any point in time between 10 cents and 15 cents. I never have a problem with that. I mean, obviously, I'm not going to sell a short spread for 15 cents. So I'm always selling them around 50 cents to $1, somewhere usually in that range. And so if I'm doing this trade, I don't mind closing this at 15 cents. And this would be the order that I would put in. This would be my paper trade to try to manage my iron condor that we put on a little bit back. All right. So let me go back and take a peek at a different trade that we've done. And oh, by the way, Google is down a little bit. So it was good that we sold the call against our position. The NASDAQ right now is down about 3 points. And I said that, well, I didn't. I said that I'm still nervous about the marketplace, but I think it's time to start building a portfolio if you had funds that you want to allocate. Now, you could wait until the big kick the can down the road date of November 17th. And that's probably not a bad idea, but we're going to chug along and assume that Congress can actually get a deal done, and that's going to be our trade. All right. So if you have any questions about this trade in general, that's fine. Let's go in now and let's look at the long straddle and the conditions that we would like to see. Like the marketplace right about where it's at. So if I look at the chart and I go back, I like this range. A lot of noise right in here. So if we stay somewhere in this range, but what I'd like to see is the VIX actually come off a little bit. And the marketplace, like I said, has woken up and brought volatility a little bit higher at this point in time. All right. I'm not moving. 1 second. All right. Well, you're gonna have to trust me, because right now I'm a little froze on my side of things. But if the VIX comes back down to that 16 level, which it was at not that long ago, and we see the marketplace in this range, I don't mind going out and buying a long straddle at this point in time. Now, we're a little bit far out on the date, on the 17th being the major day, but I want to look for the setup so that I can get in at the price that I would like to be in at. So I want volatility to come down a little bit, 16, and I'm pointing to it on my screen. I think you can see that. 1872. I'd like this to be more down around I think what I would call more normal range for the VIX, around 15 or 16%. I believe that it should be higher. Oops, there we go. I believe that it should be higher. And this is the range that we were looking at right down there. Why did that happen? Okay, right down in this range, right in here. See where the 200-day or the 20-day and the 50 days at? I think this would be a good area that I wouldn't mind getting in on this trade. And I can be patient on this trade. And then we're going to do the long straddle. And let's set that up. And I'm going to talk about two things on this. So I'm literally going to go out beyond. It's going to be fairly expensive right now. November 10th, November 17th. Let's see where that volatility is at 6. So like interesting in that the vol is staying fairly steady. Like the marketplace just thinks that this is going to happen. So November 24th would be the expiration that I would want to do. Right now we see the long straddle, and let's start tracking this 3250. So we're at 827 on the 3250. And this is the one that I want, right? Okay. And we're at 810 there, and we'll do this. Okay. So right now it's trading for 1890. I'm going to write that down. With the VIX trading at 1880. So this would be the long straddle. If we go to the what if calculator, and I'm moving slow, send a what if, there we go, come on. This is why a long straddle looks good to people that are just learning about options. The profit and loss graph looks wonderful. You are like, well, if the market goes way up, I have the unlimited potential on the upside. Market goes way down, I have substantial, can only all go down to zero. But the biggest thing is to understand this trough. Right at 432.50, this is where time decay happens. So much messes with these at the money option contracts. Implied volatility can hurt you. Time decay can hurt you. Everything about that in that scenario can hurt you. So you need to understand, if you're doing long straddles, you need to understand pricing and the concerns of pricing more so than anything else in the marketplace. Than any other strategy that you're looking at. If you're considering long straddles, you're buying two option contracts. And this is why you don't hear a lot of people talk about it as far as instructors in the options world. They're always thinking you need to sell premium, sell premium, sell premium. And I don't disagree. I just think there's a time and a place. One of the more successful straddles, and I did it over there on my podcast that I used to do within Options Insider, did a lot of long straddles in Boeing. When Boeing was having the trials and tribulations, which they're in the news today about the MAX, trying to get the planes to fly, they were getting pounded with headlines left and right, but you didn't know what the headlines were going to be. Or next week, were the planes going to fly or were they not? And the implied volatility in the option contracts was not reflecting the chance that a news headline could come out at any point in time that could massively affect the stock. So long straddles were a simple choice. They were a simple choice for me and Boeing at that point in time. In hindsight, it's always 2020. A lot of them worked out. I don't think any of them that we did on a paper trading basis weren't profitable within, I'd say, a 2 to 3 week period. So that's a scenario where the market could be surprised. And I think right now the market could totally get surprised by what's going to happen on November 17th. And because of that, It's one of the first times I'm going to start trying to get set up on a November long straddle that we're showing here. November 24th is going to be that magic date. And we're just looking for that entry point. And that's where we're going to leave it here on Options Guide TV. If you have any more questions, this is your last chance to put them in that chat box. But if that is the case, then a very interesting week going on in the markets. We're still in October, so that means sometimes it's appropriate to say, let's just lie down until the urge goes away. We need some things to kind of play out here. We're going to lean into the straddle, and that's the exact opposite of every outlook that we've had so far with our iron condors. But we're going to try to find a good entry point for that. So please click subscribe, ring the bell, pound that thumbs up, and we'll be back this Monday for the next edition of Options Guide TV. Thanks for coming, everyone.